Ta-da! Don't mind me, I'm overexcited right now. I'm just happy that finally I'm making this course. I've been documenting and implementing this for years. So I'm just happy that today I'm just giving it out to you. I just want to share it. I just feel like sharing this. Alright. So this is the model where we talk about the entries, like all my entries strategy. So I actually call my entries framework bite formula, like biting the pizza. Just like that, don't mind me. So the bite formula is actually 1, the build up, 2, the break of structure, 3, impulse and correction, then 4, trade in the direction of the stop loss cluster, then 5, ending diagonal at key turning zone. So I'm going to explain in details with live examples on the chart how this actually works. So pay attention to what I'm going to say. If you miss one step, you may miss everything. All right. So draw your notepad closer, get your biro ready to take some notes. All right. So first, let's start with the build up. All right. The build up framework actually works better on a ranging market. Okay. So now all these different strategies now, it's based on different market behavior, different market structure. All assets are not the same, all the currency pairs are not the same, all the cryptos are not the same. All right, so they are all different, so they move differently on the chart. They have different liquidity, different volatility level, and different kind of volumes on it. So the way you approach them, it's different. So the very first thing you do when you want to analyze, you want to scan the market and take a trade, first of all, understand and identify the market structure. If you miss this point, then you are missing the entire thing. All right, so you need to identify and know and also understand the market behavior and also the market structure. There are some pairs that after trending for let's say 1 month, is going to consolidate for the next 3 months or 4 months. Pairs like example are all those Swiss francs pairs, like Euro Swiss francs, Pound Swiss francs, which other one again? Which one is it? CAD Swiss franc. CAD Swiss franc. That one are the worst. It can consolidate and correct for Africa. All right. So you need to understand the asset behavior, the currency pair behavior, then also identify the market structure there. So when you know these two things, then we are ahead of the game. All right. So build up is actually used for a ranging market. Never try using build up if the market structure you are seeing is not ranging. So first of all, the range needs to be an average of 100 candlesticks. So let me do some drawings. I like drawing, though my drawing is always bad, but I like drawing. So this illustration here, this, let's say, is the resistance zone. Up here is the resistance, down here is the support zone. The market has been ranging between these levels, up down, right? Then after, let's say this range, this is the range I'm talking about. This range should be at least 100 candlesticks. The time frame does not matter if it's weekly, if it's monthly, if it's daily, 4 hour, 1 hour. The time frame does not freaking matter. First, identify the range and make sure the range has at least or an average of 100 candles on it. All right. So when you identify that, and you now look for something like this, this is what I call the build up. Now, a smaller range, or can I say a smaller consolidation within the bigger range. Now, it has to happen either on the support zone or around the resistance zone. If it's happening at the middle of nowhere, my brother, my sister, ignore it. It's a trap. All right, I've tried it on the middle of the chart, and it's always a trap. It is going to trap you. All right, and if you don't manage it properly, boom, your account is gone. You know what always happens now. I don't have to tell you this. All right, don't mind me. I'm all excited here. All right, so look for a smaller consolidation within the bigger range. Now, when this scenario is actually made for if price wants to break below. So you watch it, if it's happening at the support like this. Now the best place to buy is at the resistance of that smaller range. That is the best place to buy. If you catch a sell from there and price drops, break down and retest, you will be swimming in profits. All right, so the best place to enter is at the resistance of that smaller range, at the top of that smaller range. All right, so all you need to, now what happens now is that this bigger range, let's say, is on your higher time frame. Okay, this, let's say your higher time frame is the daily, this is on your higher time frame. Now you need to go to your entry time frame. Let's say your entry time frame is the 1 hour, to spot this range. All right, so when you see, maybe like one of my entry triggers is a engulfers. So if I should see a bearish engulfing candle on this, on the resistance of this smaller range, boom, I'm selling that thing. I'll sell it down with that. I'll sell it down because I know it's going to head down. I'll sell down from there. I'm going to sell it down from there. Then my stop loss will be some pips away from this range, from this structure here, this range. So my stop loss will be very tight because it's still within the bigger range. So my stop loss here is going to be around here, very tight, and take profit will be exactly the same number of pips of this range. So if from here to here was let's say 300 pips, my final target will be 300 pips. It won't exceed 300 pips. So that is the first way you can enter using a build up. And if you miss entering within the build up, wait for price to close below this bigger range, the consolidation, retest it. So when there is a retest, this is when you sell again from here. Now if you should miss that second entry, don't try joining this trade again because you may be trapped. Now the first and the second wave are always the best wave. That is where the money is. In fact, the second wave is where the money really is. If you miss that second wave, the third wave will be, you see lots of corrections, lots of consolidation before the wave and push ups again. All right, so make sure you don't miss the first and the second wave. That is where the money is when you are trading. So that is it for build up. I believe you understand the explanation there. But before we move to the next one, right, so let's look at the live chart and see a live example. All right, so we use let's look at gold. Gold. We look at gold. Don't mind me, guys. All right, so this is gold. All right, see this box here, the green box you are seeing here is actually a range. I spotted this range on this is a range here. So we actually need to go to the 4-hour time frame. So for this example, I'm going to use 4-hour is going to be my higher time frame. Then the 1 hour will be my entry time frame. Right, so so this is the range being spotted here. So I go to 4-hour time frame. No, wait, let me look at the dates first. That is 12th August 2020. So I go to okay, 4 then we do 12, we go back in time, 12th August 2020, this August 2020, 12, then load that thing. All right, so this is the 4-hour. You can see this range was like heavy you see, now you see the range is the candlestick is over 100. See, 195 bars, that is 195 candlesticks on this range, here. All right, then this is where the build up is happening. This is the build up, and the build up may happen in different formats. All right, the build up may happen in different format. This is the build up happening here. Right, this one, the build up was in a format of a descending triangle. Now sometimes it may happen like a range, sometimes it may be like a descending triangle. So let me look at this. 21st September 2020. So we go to our entry time frame, which is 1 hour time frame. Hey, I've forgotten that date. Okay, 21st September. all right, 21st September 2020. All right, let's go there. Right, so this is the 1 hour time frame, which is actually the entry time frame. You can see, you can spot this was a build up here, price spiked up, then started moving, consolidating. So this was actually carving a descending triangle, series of lower highs into the support. Then what happened? Price broke down, boom, retested. Then on the retest, you can see on the retest here, what did we have there? We have the, I'm seeing a bearish engulfing candle, right? Bearish engulfing candle. So where do you enter? You actually enter, now you won't enter immediately the bearish engulfing candle is forming. Yeah, you need to wait for the bearish engulfing candle to close, then at least a 50% or 61% retracement of that engulfing candle. That is where you enter. So you can see right now, you see where our entry is. Our entry is right here, right? That is 50% of that candle. So you take your entry there where your stop loss is, at least at above there, very tight. Then your take profit can be the same target, the same number of pips of that range from top to bottom, or you can just do a normal risk to reward of 1:3. But just look at this trade. I'm just showing you on the live example. Look at this trade now. It's 1:4.31. Right? See, this is gold. The stop loss was 87 pips and the take profit was 375 pips. Massive trade, good trade. This thing works like, how should I call it, like boom fire. This thing works. I know what I'm saying, right? I know what I'm saying. So that is the live example. You can implement this, you can back test it, forward test it, you know, on your own chart, on your own. You see, it's mind blowing. The same, make sure you are following the same steps I followed. So now let's look at the next entry strategy which I use. The next one is what we call the break of structure. I love this one. I love break of structure. It's cool. You know, I'm a swing trader and I love trending markets. So anything that has to do with trending, like uptrend or downtrend, I love it. So this is break of structure. You actually need to spot the break of structure on your entry time frame, right? You spot it on your entry time frame, not on your higher time frame. So let's say on your higher time frame the market is trending down, then you go to your entry time frame to try to spot the break of structure. Now the break of structure is like, okay, let's say this is a support zone right here and the market is trending down and you see price close below, you know, close below your support. All you need to do is go to the lower time frame, draw a tiny trend line there. All right, now wait for that trend line to break out. Now you see right now we were having series of lower highs and lower lows here. All right, lower highs, lower lows. Then all of a sudden price turned around and we saw a new high. So we now had higher highs, higher lows. So that is a break of structure. Some people call it change of structure. I hope you are getting the point right now. So your very first entry should always be at this bottom, but it's always hard to catch this entry. You know, you need to be damn experienced to catch this entry. All right, now the way I always catch this entry is that if that zone is a key turning zone. When I mean key turning zone, it's not just a zone on my higher time frame, maybe it's also a key zone on the weekly time frame or the monthly time frame, and I know for sure that price is going to turn around. So what I would do is, as price is making a new swing low and trying to reverse, boom, I take my entry. All right, and the stop loss will be very tight. All right, when you are taking your entries, you need to take your entries with confidence, with guts. You know, this is not you don't need to be second guessing yourself. Take that thing, set the stop loss. If price should hit your stop loss, wait for another entry, pull the trigger. That is how you trade. That is how you become a profitable trader. All right. But if you are trading with a small equity like $50 or $100 accounts, you won't be able to be doing this kind of things. Okay. So you need a good trading account like 200, 300, 500, 1,000, 10,000. Oh man, I'm being excited here, but I hope you get the point, right? I hope you get the point. So that will be your first entry. Your second entry, when you see a pullback, a 50% or a 60, most times these days price don't even respect the 50% FIP level. You see price going as far as the 61 and also the 78 FIP level. So if you miss that first entry, wait for at least a 61% Fibonacci retracement of this impulse here, of this new impulse. All right, so when you get that, then you have your second entries. But let me also let you know that price may also not just make a 50%, a 61% retracement. Now price may also do something like this: push up, come all the way back down to this bottom, now close a little bit, then do what? Boom. That is manipulation, because there is good liquidity around here. People are placing their buy limits around here, and as they are placing their buy limits, where is their stop loss? Below these lows, below these lows. So the sharks of the market, all right, the sharks may want to trade and pick up all those liquid, that is the money all around there, so it will do this. So if you don't see price turning around at the 61, let it push down to this bottom. Then when you get that rejection, join it. Like, make sure you are buying it real hard, because you're going to make money from it. All right, so you buy it real hard to the upside. So those are scenarios that may represent. But if you miss entry 1, entry 2, you may actually this entry 3 may present itself. But most times these days we don't see that entry 3, because when price makes that second wave, is always very heavy. But if you should see the entry 3, you can actually wait for a retest on your entry time frame. Just look at that small retest that will retest this zone, then you take your entry 3 from there. All right, so that is a breakup structure. Let's look at a live example on the chart. So let's go to the chart and let's see a live example, and we are going to use GBP JPY. all right, so we look at the daily. So here, GBP JPY, the daily time frame is our higher time frame here. So let's just assume this part of the chart is not yet available. We don't have this part of the charts. All right, so we only have this part of the chart. So we see price moving on the downtrend. So I'm marking out this spot right here, so we are able to use that to spot our break of structure. So where is our break of structure? That is 17 March 2020. So we go to our entry time frame. Here our entry time frame is the 4-hour time frame. So we fast forward to 17 March 2020. Don't mind me, I'm just making fun here, right? So 17 March 2020. All right, so this is 17 March 2020. So right now price was heading down. We saw a series of lower lows and lower highs, lower lows, lower highs, lower lows, lower highs. Then down here, see, this would have been your first entry. You see that impulse, boom, that would have been your first entry down here. Then this is your second entry here. You see, let me even use Fibonacci and plot this thing out for you. So you see this Fibonacci, pick from these lows, we are measuring this impulse to these highs. You see that level there, it was almost 61% retracement level. So then we have that hammer candle stick there, then the bullish engulfing candle, then boom, price went all the way up. So this was the first entry, second entry, and this is the third entry, where you see price retesting this support zone there. So that is a live example. I know you may be saying, and a bit you are cherry picking this chart then. Yes, I am, because it actually worked there. Right, so you need to look for identify and spot an asset or currency pair that is actually moving in this manner, so you'll be able to, you know, trade well. All right, so that is a break of structure. All right, so let's move to the next one. Next one is impulse and correction, and I love this one too because it's always in line with the trend. Anything that has to do with the trend just counts me in. All right, so as far as it's moving in the trend, on a trend, counts me in. I'm always happy, you know, to follow. So impulse and correction is another strategy I use on my entry. So now you need to use this on a trending market. Use it on a trending market only. If the market is ranging, ignore it. All right, so use it on a trending market only. All right, so and the correction here should be at least 50 to 61% Fibonacci level. So this is the impulse, the first impulse down here. We have the first impulse down here, and this is the correction, an ABC correction here. See, my drawing is bad. So this is an ABC correction. You want to see this ABC correction breakout, right? And that ABC correction has to, you know, up to 50, 61% Fibonacci level. So when you get that, that is where you have your first entry. You know, at that level there, you have your first entry there. All right, so now your second entry has to be at the retest of the previous impulse highs. All right, so this is the first impulse. All right, so this is the highs of that first impulse. Price needs to break above that impulse, retest it. That is where you can now get the second entry. If you miss the second entry, you're out of it. You may not see a third entry, except you are a pro or a well experienced trader. You can go down to a lower time frame and just look for a smaller, you know, pullback impulse, then boom, you join the trade to the upside. I love the impulse and correction strategy here. I love it like I don't want to say like maths but I've said it actually. So this is the impulse, the first impulse here. Then we have the ABCD correction, the ABCD wave. So that ABCD wave at the end of the day will lead you to the 61% Fibonacci level. Now I want us to share this with you. It just entered my brain. I want to share it with you. So now you see this is the pullback wave. This is another short impulse. Now sometimes this leg may extend to these highs. When you see it extending to these highs and rejecting, don't try buying. It's a trap. I'm not telling you how to spot these traps. Don't try buying it. It's a trap, because price may drop back down, back to that 60% Fibonacci retracement before that leg. You know, sometimes you see it happens like this. After when price slows down, drops, pull back, goes up again, close a little bit above that highs, then drop. Now, except you are a short-term trader, you like trading against the trend, right? You can now sell this for short term. You know, you can sell this for short term, but I don't recommend that. I don't advise that. Always trade in line with the trend. That is my recommendation, right? So whatever scenarios present itself around here, make sure you understand the structure and you understand what the market is doing. If you don't understand the structures and what the market is doing, you are going to lose out, and you are going to lose money for real. So so first entry at the bottom here, at least the 50 to or 61% retracement. Sometimes it goes deeper to 78% retracement. No issue. Just take a buy position whenever you get your entry triggers, right? And your stop loss, you know, very close, very tight there. And the second entry is up here at the break and retest of the highs. That is where you have your second entry. So don't miss. If you miss the first entry, don't miss the second entry. The second entry is always massive. It's always massive. All right. So let's look at the live charts. to see how this thing works on the live chart. So which currency pair? That is impulse and correction, right? So we are going to use GBP USD for that. GBP USD. So for this particular example, we are going to the daily time frame is going to be our higher time frame, and we use the 4-hour time frame as entry time frame. All right, so this is it. We actually saw price pushing up. Fine, price is pushing up, but what I want to point out to you is now we are seeing price reject this key turning point here, the 1.3487 zone. That is a key turning point. If we should take this chart back to the monthly time frame, let's go to the monthly time frame so that I want us to shrink this chart. All right, so this is it. You see price bouncing off that zone. See price, this is the monthly price bounce, so it's a key turning point. See price bouncing off, and now price is there again. So what do you think price will do? It will bounce off because it's on the monthly time frame. It's like very key time frame there. All right, okay, so you see price is rejecting that zone and carved a nice pin bar, just like the way I loved it. Very nice, interesting pin bar, right? So price carved that pin bar, then pushed down, broke below this trend line, and did what? And retest. All right, so we have now identified our what? Market structure. We now know the market behavior. That is phase 1. All right, so what is price really doing? You see price broke down. Fine, we want it to sell, but it's not selling immediately. What are we seeing? And a correction. This is the impulse and this is the correction. If we should plot our Fibonacci right here, from this top here to this bottom, what are we seeing? All right, you see price have actually pulled back, like corrected over 78% retracement level. Imagine. All right, so if I'm trading this right now, this is actually the live market. So if I'm trading this right now, I'm going to sell. And also to add to it, you see, let me go to the 4-hour spot this. All right, so let's go to the 4-hour. All right, so you see this is the 4-hour, and what is price doing? Price is even carving what looks like a bearish flag. A bearish flag. You see from here, see this top here and see this bottom here. Price is now carving a bearish flag or up here, right? So, and there's a rejection. There's a rejection there. See that lovely, oh wow, I feel like taking this trade right now. See that lovely rejection up there, and price is sliding down. I actually plotted this trend line so that I can track and know when exactly I'm entering. So if you go to, let's even go to the 1-hour and see how that trend line looks like. Now this is the 1-hour. This is the 1-hour. 1-hour. Let me speak English small. All right, so this is the 1-hour. So price did what? Broke below that trend line and what? Retest. So if you wanted to enter like the market right now, it's either you enter from here, but if you missed it, this was another opportunity for you, right? Now you can still enter this trade, right? So all you just need to wait for price to maybe go back up a little bit, tag these highs. You can place a sell limit here. And your stop loss will be here. The stop loss needs to be tight because price can still go as far as this before dropping. Okay, so your stop loss needs to be very tight. All right, so you place a sell limit here and your stop loss up there, then you sell it to the downside. Where will your target be? Your final, when I mean final target based on market structure, your final target will be down. If I should calculate this, if I should calculate it from here, let me use the what do you call that thing? Position tool, the short position tool. Let's say we just want to enter at the highs of today highs, and our stop loss is at yesterday highs. See, based on daily, this impulse was how many pips? Let's look at this impulse. This impulse was 800 pips. Imagine that. So take profits will not be more than 800 pips. So 800 pips, 800 pips, 800 pips. Where is 800? You see, just imagine the risk to reward 1:7. And what is your stop loss? Your stop loss is just 111 pips, and you're going to make 800 pips. So it's just, this thing is cool. It's cool. It's cool. All you need to do is implement, learn how to train your eyes to spot how to identify market structure. So when you know how to spot this market structure, all right, then you start implementing. That is the only way. That is the only way out. If you don't do it that way, then you are going nowhere. You may not be catching or making profits from the market. Okay, so we move on to the next one. Right, on to the next one. The next one is, you need to trade in the direction of the stop loss cluster. This is very cool for the scalpers. This is what I wanted to give to the scalpers for free, but something inside me said no, keep it for the entries and exit pizza. So this is for the scalpers out there. All right, so in the first module of this course, we talked about liquidity. This is where liquidity really comes to play. You should understand and know how to gauge liquidity on a particular asset or currency pair for this particular strategy to work well. So my scalpers friends, I don't really like scalping, but my scalpers friends, this is for you. Okay, now you need to be able to, you need to spot a valid market structure, then look at where cluster of stop losses are. Where you have cluster of stop losses, that is where there is liquidity. Then you trade in that direction. So this illustration actually shows that price is trending up. You have the blue and the red lines there. So this these are impulse to the upside, pullback, impulse to the upside, pullback, impulse to the upside, pullback. So this is a clear uptrend. So majority of retail traders, do you know what they will do? They will plot a trend line and they find themselves, yeah, market is on an uptrend, we are going to buy, we're going to make money. Then they actually miss the first impulse. Obviously they miss the second one. Some of them cut the third impulse. All right, so now price has pulled back to where? That trend line. And what do you think they are going to do? They want to also still buy at the trend line. So so many traders at Abakaliki, traders at Lagos, Abuja, everywhere, they'll be waiting to buy at where? The trend line, this zone. So some of them, they will even start placing buy limit orders around there. You know, some will even place buy stop orders around here, this around this zone. And where do you think their stop loss will be? Below there, down here, even up to this point. They'll still have stop losses up to this point. Then the sharks, the big players in the market, will come in and say, so these people does not want us to make money, let's do them strong thing. So for a smart trader like you, right, when you see price have already bounced up from a trend line like 2-3 times, don't really think about trading it again, you know, buying it up. It may actually drop down. So what will happen around here? You see a small impulse to the upside. Now this impulse now is to induce more people to buy, because when there's an impulse to the upside, so many retail traders will now say, wow, it's going up, it's going up. They'll start placing more orders, more buying orders, more buying orders, more buying orders. And where will their stop loss be? Down here. So buyers will be induced. Then you, as a smart trader, what will you do? As a scalper, what do? You need to trade in the direction of that stop loss, because definitely that is where the market is going to go. See, I'm sure about what I'm saying. It has been back tested, and I have personally forward tested it. Price will go in the direction of the stop loss clusters. You know, at least price the price will take off all this cluster of stop losses before that push up to the upside. So this will now be a bigger correction. This will now turn to a bigger correction, something like this: A, B, C, then continue pushing to the upside. We now have a bigger correction. This is a structure here, right? So you need to be smart, you need to be proactive when you are thinking, right? So so that is it. We go to the live chart and see what is happening on the live chart. So for this one, let's use a UD card. Alright, so this is a UD card. So we take the daily time frame to identify the market structure. Right now we see that this is an obvious level. The 0.93977 is an obvious level. This level you see here, price broke. There was a cluster of retested, then we see a breakout, price retested again, then here. So let's assume this part of the chart is not there, this other part of the chart is not there, right? So we go to the 4-hour time frame. That is where we are going to see a clear rejections on this. So where is our dates? So we go to 7 September 2020 on 4-hour. 2020 is the year of Le Parase Farase. I don't know what that guy said actually. 17 September, where you come out and make let's shrink the chart. So so this is the 4-hour time frame. You can see price bouncing off here, and this was close, and yes, we have to bounce here, rejection to rejection here, so that is about 4. So here is where, as a scalper, you should look for your entries. Let's bring this back to life. So around here, you see this is a reversal candlestick here. You see, price comes down, then a bullish candle closed above, keep pushing up. That is inducing buyers. They are inducing buyers, and you see more traders will now start placing their buy position. Then what do you see? Price drops down. So as a scalper, you won't take your trade on the 4-hour or in the 1-hour. So maybe you take your trade at the 15-minute time frame or at the 5-minute time frame. But for this illustration, I'm going to use the 15-minute time frame. All right. So I'll go to 15-minute time frame. That is 13th October 2020. 13 October. So we go to 13 October. Alright, so this is 13 October here. This is what happened on the entry time frame. So we had that bounce. You see the bounce happening around here. See, bounced off, price keep pushing. Yeah, now as a smart trader, all you need to do, just let price go, set a sell stop around here, set a sell stop there. Alright, set a sell stop there, then wait for price to come back, activate your sell stop, then keep pushing. That is how you scalp this. That is how you scalp this. So you set a sell stop at that price level, and your stop loss will be at least at above this range. Let me use a horizontal ray tool there. Say, alright, here. So that is where your stop loss will. Why I'm placing this stop loss is a logical place. You see, price bounced off on the lower time frame, price bounced off again, and price bounced off. So that is why I'm setting my stop loss there. You don't just set your stop loss at any place. Your stop loss should be at a logical place. Alright, so in case price takes you out, you know, okay, this is why it happened. So and if I should extend this, that was, we set a sell stop there, and you see what happened. Price actually went in the favor. See, price broke down, retest. This is another entry. You would have had another entry here. See, price broke below, retest, then dropped again. So entry, sell stop entry there. If you miss the sell stop entry, then you entered a direct trade from here. A direct trade from me. I'm a conservative trader. I think I will even prefer the direct trade, like from here, like after the breakdown and retest, you take a direct trade from here, and your risk to reward should be at least 1:3. So you see, your stop loss is 5 pips, take profit 19 pips. That is all what the scalpers need, right? So that is it for that, trading in the direction of the stop loss clusters. So we move on to the next one. On to the next one. I don't know if you guys know about that song. Jay-Z, back in the days with Beyonce. On to the next one. I love that song back then. Don't mind me, I love music, sure. I used to be a chorister until some things happened and I left the choir. But don't ask me what made me left. I won't talk about it. So let's go back to entries and exit pizza. Alright, so this particular strategy, it's called ending diagonal at key turning zones. So if you are a zone to zone trader, I will really recommend you adapt this. Like you trade from one zone to the other. Trade from zone A to zone B, from zone B to zone D, from zone D to zone Y, whatever. So if you are a zone to zone trader, adapt this entry strategy. It's going to work perfectly well for you. So looking at this illustration here, you see this is a resistance zone of here. This is a resistance zone, and price was in a very good uptrend. Then price breaks above and closes above resistance, retest the resistance, then start moving correctively. Now the push to the upside is not strong, it's moving slow, and it's now forming. At the end of the day, it's forming something like a channel. You see, it's forming something like a channel. Sometimes it's always a channel, sometimes it's like a, how do you call that thing, like a rising wedge, like it's closing. Yeah, so when you see price making this move, just know that this is a way the sharks in the market are inducing more buyers. They are inducing more retail traders to keep buying. They keep buying. When you are buying, where is the stop loss? Down here. Then what will happen? Market reverse and continue in the right and normal direction it should go. So this is a manipulation. So when you see this, even if you are buying for short term, buy with extreme risk management, or else you lose money. All right, but I don't even recommend you buy. So when you spot this, just wait for that breakout to happen. All you need to do, as price is pushing up, target a new high, you can take a sell position, a short term sell, a short term sell again. Then you can this, your first entry has to be here. So price needs to make at least 3 touches on that channel resistance. This is the first touch, second, third. Then on the 4th touch, when you see a rejection, sell it hard. This you can also apply this when the market is on the other way around, like when it's at the support zone and it's forming an ending diagonal. So you sell it hard, right? If you miss the first wave, you have another opportunity to enter. So, but the opportunity to enter, you need to wait for price to close back below the resistance zone, retest it. That is when you take your second entry, right? Don't miss the second entry. If you miss the second entry, you are in pepper soup. So don't miss that second entry. All right, so that second entry is going to be massive. Like, it's always, the second wave is always huge. The second wave is always huge. The money is in the second wave, so don't always miss the second entry after I pull back. All right, so let's go to the live charts, all right, and see how this thing works out. All right, for live charts, or which currency pair are we going to use? Let's use Euro Swiss francs. This is another king of consolidation. This pair can consolidate for Africa. All right, so we start from the weekly. We use the weekly to spot our key turning zone. Let me shrink this. You see what is happening here on this chart? This is key zone. This is a key zone. 1.0569 is a key zone. 1.0194 is a key zone. Right, that is a key zone there. So what is happening at this key zone? Let's assume these are the parts of the chart is not here. From here is not yet here. So we see price on the downtrend entering this key zone. So our entry time frame here is the daily time frame. Okay, so we go to the daily time frame and we try to spot an ending diagonal. So you see it's happening here. Price came to the support zone, bounced off, and start moving like this. You see, that is an ending diagonal. Then we now have this big impulse to the upside retest. So your entry, your first entry would have been here. If we should go down to, let's say, the 1 hour time frame or 4 hour time frame, I believe we had an entry there. Let me mark this up and just share it with you. We are all learning, so let me share it with you. That was 12 May or 13 May 2020. So we go to 4 hour, 12 May 2020. Click on this. 12 May. May I not, my lord, may I? 12 May. All right, 2020. So right there at the lower, way lower time frame, see what is happening. Let me delete this so that you see what is happening. If I were full, like, we actually took this trade, or actually, so we took this trade. I shared the signal. We took this trade this year. It's on the Telegram channel. Like, as a smart trader, you see price coming down and he's doing this. Personally, I would do this. I would draw this. Once I see this break, let's just assume you miss this big impulse here. That's about how many pips there. Let's look at that. This impulse, that is about, it's not even big self, 100 pips. So let's assume you miss that impulse, you miss that first impulse. Now your entry is at this consolidation here. You see price consolidating around here. You buy at this lows here, or you buy at the breakout of these highs. That is the way you approach this kind of market structure. All right, so you buy on this. You see, you actually buy at the lows here, or if you miss that first entry here, this was your second entry, right? Then price pushed all the way up, and since then you agree with me that price is still at the top. Price is yet to, price have not even come back to this lows again. All right, to this lows again. You haven't seen price back at this lows. So that is a short entry strategy. All right, so that is it for the ending diagonal. So that is all the strategies, my entry strategies I use, and how I approach different market structure, different market behavior. Right, so you don't just watch this training then go back to sleep. You know, you need to practice how to trade the build up, practice how to trade the break of structure, practice how to trade the impulse and correction, practice how to trade in the direction of the stop loss. Even if you're not a scalper, just understand this. You can still use this in swing trading. All right, but you can still use this in swing trading, but I just infused it here because it works better. You know, if you infuse it in swing trading, you are looking for up to 300-400 pips. All right, so if you use it in swing trading in the direction of the stop loss, you may not really have that number of pips. So that is why I said it's better for scalpers, because scalpers are looking for 20 pips, 30 pips, 50 pips at most. Right, so practice how to trade with the ending diagonal at key price zones. Don't just watch this video. You can go through this model over and over again. Go through it 3 times, 4 times. Let this thing sink in. Then implement. Write this framework down on your notepad. You write it down. Then you make sure that the market is meeting each of these criteria before you pull the trigger. If the market should meet each of these criteria, then you pull the trigger down. Let me see how you will not make money. Fine, this may not work 100% of the time, but I'm telling you 90% of the time this is going to work. As far as first you identify the market structure, then you scale down to your entry time frame, which is the lower time frame, to fine tune your entries. The next models, I'm going to share with you the exit strategies which I use to exit my trades. You know, I don't just exit my trade because some guy at Ikorodu is telling me Euro USD is going to sell, then I take off my buy position. No, I don't do that. So I'm going to share with you the exit strategies which I use in the next model. So this is a lengthy video. I didn't really want it to take this long, but it's taking long. I couldn't help but share and pull out everything I have up here to you, so that you can learn and also make profit from forex trading. All right, so I'll see you in the next model.